Hey, welcome back to Alex Invests, where we make money simple. Quick question for you before we start. If someone handed you $50,000 today, would you put it into real estate or would you invest it in the stock market? Most people have a strong opinion. But here's the problem. Most people have never actually run the numbers. Today, I'm going to do that for you. No complicated finance terms, no fluff, just real math, real scenarios, and a clear answer by the end of this video. And I promise, once you see the full picture, it might completely change how you think about building wealth. Let's get into it. To keep this simple, I want you to meet two people. First, Jake. Jake is 30 years old. He has $50,000 saved up. He uses it as a down payment on a $250,000 rental property in Texas. He gets a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,330. He rents the property out for $1,800 a month. On paper, that looks amazing. $470 profit per month. Easy money, right? Not so fast. Here's what Jake also has to pay every month that most people forget. Property taxes, around $250 per month. Home insurance, about $100 per month. Maintenance and repairs, roughly $150 per month. And let's say the house sits empty for 1 month per year. That's another $150 per month averaged out. So Jake's real cash flow in year one? About negative $180 per month. He's actually losing money every month at the start. Now meet Marcus. Marcus also has $50,000, but he puts it all into a simple S&P 500 index fund. Something like VOO or FXAIX. It tracks the top 500 companies in America. He doesn't pick stocks, he doesn't time the market, he just invests and lets it grow. And because he has no property expenses, Marcus can invest an extra $500 every single month. Same starting money, completely different paths. Let's follow both of them and see where they end up. Okay, let's fast forward 10 years. Jake's property at year 10. U.S. home prices have historically gone up about 3 to 4% per year on average. So Jake's $250,000 home is now worth around $345,000. That's $95,000 in appreciation. Not bad. He's also been paying down his mortgage. After 10 years, his loan balance is down to about $170,000. So his equity, which is the value he actually owns, is $345,000 minus $170,000 equals $175,000. He started with $50,000 down. Now he has $175,000 in equity. That's a 250% return on his original investment. Sounds incredible, right? But wait, let's count what he actually spent over those 10 years. Mortgage payments over 10 years, about $160,000. Property taxes, insurance, maintenance over 10 years, roughly $60,000. Total out of pocket, $220,000. And what did he collect in rent? Averaging around $2,000 a month over 10 years, that's $240,000 in total rental income. So his actual cash profit from the property, after all expenses, is about $20,000 over 10 years. That's only $2,000 per year. Plus, he put in a lot of time. Dealing with tenants, repairs, property management calls. That's real work. Now let's check on Marcus at year 10. The S&P 500 has returned about 10% per year historically. With his $50,000 starting investment and $500 monthly contributions, Marcus's portfolio has grown to around $215,000. Zero effort, zero tenant calls, zero maintenance headaches. So at year 10, Jake, $175,000 equity plus $20,000 cash profit equals roughly $195,000. Marcus, $215,000 in index funds. Marcus is ahead, and he didn't do a single thing. But here's where the story changes completely. Let's go to year 20. This is where real estate becomes really powerful. At year 20, something big happens for Jake. His mortgage is almost paid off, and his property, which started at $250,000, is now worth around $475,000, assuming the same 3.5% annual appreciation. His remaining loan balance is down to about $100,000. That means Jake's equity is now $375,000. And his rental income? It's grown too. He's now charging $2,500 per month. But his mortgage payment is still the same, because he locked in a fixed rate. So after all expenses, Jake is now making around $600 to $800 positive cash flow every single month. He went from losing money to printing money, and a $375,000 asset that keeps growing. Now Marcus at year 20. Still contributing $500 a month, S&P 500 averaging 10% a year, Marcus now has about $570,000 in his index fund. So the numbers? Jake, $375,000 in equity plus positive monthly cash flow. Marcus, $570,000 in index funds. Marcus is still ahead on total dollar amount. But here's what's different about Jake. Jake can now use leverage. He can do a cash-out refinance and pull out, say, $150,000 tax-free from his home equity, and use that to buy a second rental property. Now he has 2 properties appreciating, 2 rental incomes, and double the wealth-building engine. That's the real power of real estate, using debt as a tool to multiply your returns. Marcus can't do that with stocks. He can sell shares, but he can't borrow against them the same way to buy more income-producing assets. Now, and this is important, leverage works both ways. If property values drop 20%, Jake loses $95,000 in equity almost overnight, and his bank might come calling. With Marcus, if stocks drop 20%, yes, his portfolio shrinks, but he doesn't owe anyone anything. He can just wait, and history shows the market always recovers. Okay, so by the raw numbers, index fund investing slightly outperforms over 20 years, especially when you factor in how much effort real estate takes. But real life is more complicated. Here are 5 factors that could completely flip the result for you personally. Factor 1. Your local market matters more than national averages. If Jake bought in Austin, Texas in 2015, his property didn't go up 3.5% per year. It went up closer to 12 to 15% per year. His equity would be close to $1 million today. Real estate is hyper-local. The national average means almost nothing for your specific city and neighborhood. Factor 2. Tax advantages nobody talks about. Real estate comes with tax benefits that stocks simply don't have. You can deduct depreciation, which lowers your taxable income even when you're making money. You can deduct mortgage interest. And there's something called a 1031 exchange, which lets you sell a property and buy another one without paying capital gains taxes. If Jake is in a high income bracket, these tax benefits could make real estate dramatically more profitable after taxes. Factor 3. Your personality. This one is huge, and most people skip it. Are you the type of person who checks their investment account every day and panics when it drops? Then stocks might actually be dangerous for you, because the biggest risk in investing isn't the market. It's you selling at the wrong time. Real estate forces patience. You literally cannot sell a house at 2 a.m. when you're panicking. That illiquidity, which sounds like a negative, actually protects a lot of people from themselves. Factor 4. Your time and skills. If you're good at finding deals, negotiating with sellers, managing repairs, and screening tenants, real estate can massively outperform any stock market return. But if you hate all of that, you'll make bad decisions and underperform. Be honest with yourself here. Factor 5. Diversification and risk. Marcus owns a tiny piece of 500 different companies: tech, healthcare, energy, retail, finance. If one company collapses, it barely affects his portfolio. Jake's entire net worth is in one property in one city. If that city's economy struggles, businesses leave, unemployment rises, Jake's property value and rental income both take a hit at the same time. Concentration risk is real, and most real estate investors don't think about it enough.
All right, here's my honest take. There's no universally better option. The best investment is the one you'll actually stick with for 20 or 30 years. Choose index fund investing if you want simplicity. You don't want to deal with tenants or repairs. You want to be diversified across hundreds of companies. You're disciplined enough to not panic sell when the market drops. You can open a Fidelity or Schwab account today and start with whatever you have. Choose real estate if you live in a market with strong rental demand. You have the time and interest to manage a property, or the budget to hire a property manager. You understand you're running a small business. And you want to use leverage to build wealth faster than the stock market allows. And the worst thing you can do? Nothing. Inflation is running at 3 to 4% a year right now. Every year you leave your money sitting in a savings account, it's losing value. Waiting for the perfect moment to invest has cost more people more money than bad investments ever have. Start where you are. Use what you have. Pick the vehicle that you will actually stay in. Because in investing, consistency beats strategy every single time. Even $100 a month in an index fund, started today, will be worth more than $1,000 a month, started 10 years from now. So there you have it, the real math on real estate versus stocks. Both can build serious wealth. Both have real risks. The one that works for you depends on your goals, your personality, your market, and how much time you want to put in. If this video helped you think clearer about money, drop a comment below and tell me, are you team real estate or team index funds? I genuinely read every comment. And if you want to see me break down more comparisons like this, like real estate versus starting a business, or index funds versus dividend stocks, make sure you subscribe and hit the bell so you don't miss the next video. Links to calculators and resources I mentioned are in the description below. Thanks for watching. I'll see you in the next one. Take care and keep investing smart.